Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Hello, Jim.
Danielle, taking a look at how the economy in Canada could change but hasn't, are we still relying too much on digging stuff out of the ground or pumping it out of the ground instead of building smart things?
Well, that's been our problem for quite some time, and the commodities boom from the early 2000s into 2011 really made us convinced, it seemed, that that was all we ever needed to do because we had what the world wanted and we were this global hardware store of sorts, along with Australia and New Zealand and some of these other commodity-centric economies. However, since then, we've learned that it turns out the world is awash in excess capacity now, production. Many places and countries that weren't pumping these types of products out in the past through technological advancement, etc., have been able to do so. So we now have a lot of hardware stores selling a lot of the same product, and of course that has led to a suppression of price, which I think is going to be the trend for quite some time here. So we do have an opportunity in Canada to rethink how we want to structure our economy and our incentives. And frankly, the other problem, of course, was we fell back onto real estate because that was the other go-to. And in the past couple of years have been incredibly dependent upon growth in the housing sector. As you know, in the West Coast, and as we've experienced dramatically in Ontario as well, that the influx of foreign funds and the free capital flowing through our banking system, the low rate environment, the lax lending standards, all this really convinced everyone all we needed to do was, make fancier and fancier housing. And really what it's done has been a great disservice because we have, while at the edges it's been driven by foreign capital flowing in, speculative fervor, trying to collect housing like a game board, what's the game I'm trying to think of? Monopoly, that's the one. It's really not productive. It's in fact counterproductive because a shelter is a shelter, and a shelter that was $500,000 does not offer more utility when it's $1 million. In fact, it's less utility because you have to put a lot more of your resources into acquiring and debt service of the principal and all the stuff that goes along with home ownership. So we've really made wrong decisions, and not surprisingly, doing that has not increased our productivity in our economy. And so, this holy grail of economic theory is that you get revenues allow for business investment, which doubles down on innovation and technology, which leads to, new products, new types of service, and creates jobs, and then that becomes consumption domestically, and all that. That virtuous circle has really been broken because we have not had companies investing in innovation and technology to a larger degree in Canada. Business investment has been weak and falling for the past several years since the commodities boom peaked. And again, now we've had this huge concentration of whatever money we have had going into the housing sector, which, as I say, doesn't produce greater productivity. It produces the opposite. So what we have here is an opportunity once more, as oil fluctuates again back around $50 a barrel, and the world's still awash and consumption continues to disappoint. We really have this opportunity to reinvent ourselves, and I'm happy to say that there is so much really exciting stuff going on in the tech sector, in smart energy, in things like net zero housing, these are areas where Canada could actually become a world leader. The challenges of our climate present such rigor that we can develop, modular housing or net zero housing with technologies that, if they are sufficient and successful here, will be marketable all over the world. So we have companies like Bone Structure out of Quebec, which is making these really amazing, again, net zero, meaning, you produce more energy in the home than the home uses. So not only does the homeowner get to live there without creating carbon footprint, or paying utility bills, but they get to, in many cases, sell energy back to the grid. So what becomes a net drag on your pocketbook now, which is significant monthly, can become an actual inflow of capital instead of the opposite. So another really cool company is Landmark Homes out of Edmonton, which have another really great product in this line, and I put some information about it on my blog this week because, in an era where the average home price is well over $500,000 in Canada, they're producing these, net zero homes for under $400,000, including GST. They're brand new. They're beautiful. They're incredibly energy efficient, and they come with all the systems that you need to recycle, your water, to recycle the hot water flow back to energy, to produce your own power on your roof. And none of this is even talking about having a Tesla Powerwall, which you can add to your garage area for, $3,000 and have your own watts kept in-house. So, you can attract your own energy, drive your own house, store a significant amount in your Tesla Powerwall, and then sell back to the grid. So in this era where we've got the highest debt levels ever in Canada, and many people are barely making it through their monthly payments and being able to afford things, the answer from here is not to add more debt or make houses go up more so people have to, or it's impossible to afford a shelter. The answer here is to get a lot smarter, more efficient, and productive with our resources. And that we can do. Thanks to the technological revolution, the computing revolution over the last 15 years, we now have capacity of things that we'd never, even dreamed imaginable. So it's all happening very fast here, and I think that therein lies the solution. The way out of this very destructive, wasteful period that we've been through, throwing good money after bad in non-productive pursuits, we now have an opportunity to, do things. And I always say, if people don't care about health or the environment or air quality, that's all fine and well. But surely you care about lowering your monthly expenses and making it so that you're not paying money out, but actually bringing in income. And I think that, in the low-yield world where interest rates are minuscule, wage growth is flat, people are looking for creative ways to cut overhead and increase income. All this makes perfect sense, and it's come at the right time.
Well, talk about high tech. At some points of some days or even for weeks, half of California's power is now solar.
Well, absolutely. And, they're kind of a community of their own over on the West Coast there, down from you, but other than water, which is a huge challenge they have to work on, they've, with Arnold Schwarzenegger being their governor for many years, a Republican, but a very forward-thinking person when it came to environmental and energy usage. They've been really on the right train there for a long time. And so they have a head start. But there's just so much that can be done here. We still have so many, solar arrays are still scarce and scant when you consider that most buildings, not just the roof, but all the window surfaces, everything can become enormous solar receptors, which is just free energy waiting to be taken.
Even the driveway can be coated with solar cell material.
Absolutely, all of it. So, to me, this is the perfect time to come where people realize that it's, doubling down on container ships of consumer, junk from China is not the way out here. This is all connected. We need to get a lot more frugal and intelligent with the resources that we have, because that's how we'll get ahead. That's how we'll have net savings. That's how we'll have less waste and harm around us that we then have to pay to clean up. And I think it's just the way forward.
We'll have more with Danielle Park right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
I'm Bill McWilliam, President of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're speaking with Danielle Park. Danielle, you live in the greater Toronto area. Ontario has brought in a whole bunch of new regulations they hope will cool the real estate bubble. What kind of details can you give us on it?
Yeah, so I watched the press conference today, and they did announce that they're going to bring in more stringent rent controls, because, of course, that's been one of the big problems. The rent controls were taken out in Ontario in about 1991, and since we've had this galloping housing market with prices, going up 30 and 40% a year, we have a great capital outlay, as I said, for people that are trying to acquire these properties. So they necessarily or naturally want to increase the rents they're charging to people. But some of the stories are like, people facing 100% or 50% rent hikes, and they literally are pushing, working, productive people out of the city and into, surrounding areas because they can't afford to live there. So it can be very destructive to the community of the town itself, and that's not just in Toronto. This is the thing. I hear this conversation all the time that this is just a Vancouver and Toronto problem, but it isn't, because as I say, anywhere an hour and a half perimeter all around these large centers, you have this bleeding of these manic conditions into the countryside, so that the average home price in the town where I live, an hour north, has gone up 40% just in the last year. So it really becomes nut job territory, and people are not saving for the future, not able to afford basic necessities, because they're having to pay so much just for shelter. So it was smart they brought in the rent controls today, and they also are introduced a similar tax like you guys did in Vancouver, the 15% non-resident tax, with some intelligent parameters around it, that if you end up becoming a permanent resident or, end up staying in the community, you get to have a rebate of the tax. But it is a smart thing to do. It's too late. They should have done it a long time ago. Here's the thing. You've got all these people on this sort of taking end of the speculative movement in the real estate sector the past few years, the broker-dealer lender community, who are all crying, you can't touch this, because if you do, you're going to bring down the Canadian economy. And at the same time, they're not recognizing that it's because of the underwriting of the government, the extending of CMHC coverage, the underwriting of the banks, the bailouts that happened in 2008. All of this really led to this government-supported fiasco, which we are all going to pay for in the long run. This is going to be, we're going to pay in many ways. It's going to be a function of, we've already paid because, as I say, productive capital that could have been used for much more, efficient things, and innovation and advancement of long-term things we need to work towards, has been funneled into this non-productive resource. Again, shelter's lovely, but doubling and tripling the house every 3 or 4 years in terms of price is a complete disaster. So anyway, this is all a little too late, but it's imperative because government has played such a leading role in inflating the problems that we have that they ultimately, and this is always typical, they get finally embarrassed into having to help deflate the thing ultimately because, rents get out of control and the numbers are so garish that everyone's shocked. So I think it's at the margin. This is going to have a calming effect, just as it's done in the Vancouver sales market. Certainly, I've heard talk. They think that there's some sort of rebound happening, or hoping there's a rebound happening in terms of sales volume again here in the West. But you did have a 40% decline into February, and I think that typically sales volume decline precedes price declines, and price declines are the answer. I know no one likes that payback period. I own real estate too. I'm not delighted that, it's got to go down significantly from here. But at the end of the day, that's the only way back to a sane sort of equilibrium, that, we need to have people who can afford their life. We need to have people who have positive cash flow, who can save for the future. We need investments to make sense on a cash flow basis in terms of what they're paying the person for the exchange of their capital. When it's all just, math and measurements make no sense, and everybody's just throwing stuff at the wall and hopes it goes up and some greater fool takes it. I mean, that is just not a good environment, and it's not going to serve us long term. So we're going to have to do this payback period, and that means there's going to be some bankruptcies, there's going to be some write-offs and write-downs, there's going to have to be evaporation of ethereal gains that ought never have happened in these asset classes. And it, no one likes that, but ultimately, as I say, getting to a more affordable, efficient system is exactly what's needed here.
Well, if Toronto and Ottawa could look over the Rockies, Toronto wouldn't be going through this pain. But of course, the rest of Canada looks at Vancouver as being a bunch of sushi-sucking, pot-smoking, tofu-munching, sandal-wearing hippies. And we don't count.
I don't know about that.
And we don't count. But watch, once it happens to Toronto, now it's a Canadian problem, and they're going to do something about it.
Yeah. Well, they, as I say, I think you guys, because your pricing is even that much more extreme, it was, you were prodded to action, or the government was prodded to action sooner.
Again, too late. Way too late.
And again, too late, yeah. But, these ideas about how do we keep prices where they are, that's the wrong thinking. Like people saying, well, all we have to do is increase supply, or all we have to do is, help homeowners who don't have any money. We'll loan them some more. We'll get them some more debt, and then they'll be able to get in. That's all the wrong thinking. What we need here is mean reversion. We can't keep trying to push this dead thing, to keep going when it's not producing anything and not helping or going in the right direction. So I was writing on my blog about my hometown Barrie, because the reality is, and this is the case across Canada, why can housing prices not continue to go up? Because they've completely lost any connection to income growth in the real world, to wages, right? Wages haven't gone up anything close to the gains we've seen in shelter costs. In fact, wages have been flat and declining in many parts of the country. And, even again, in the CMHC report of my hometown, they note, jobs have been declining, full-time jobs have been declining in all age groups, especially in the 45 to 64-year-old age group. Only part-time jobs are on the rise. All these major industries that had the best, like tech and manufacturing, that had historically the best paying jobs, are in retreat in these areas because they're being crowded out by this obsession for non-productive investment in shelter. So the only things that are really booming in this area are construction-based jobs, which are, as I say, highly levered at this point. Everyone's driving around in a new truck with huge payments. And then you've got tap parlors, basically tattoo parlors and check cashing franchises are all widely expanding. But this is not how you build a solid community or a solid economy. This is all doing it the wrong way. So I think we're in for, as I say, this mean reversion period. We had one of these in 1990 last, 1980 before that. This one's gone on a long time, and some people will learn some lessons the hard way in this cycle. But it is a necessary evil, I'm afraid.
We'll have more with Danielle Park right after this.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa. by a fellow Canadian junior. With a proven operator and finance team, GEM International trades on the TSX Venture Exchange. Symbol GI. Visit us at gemdiamondmining.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Danielle Park. Danielle, if we want a sustainable, less hot economy, where should people be putting their money right now to at least keep it, if not lose it, if the markets go down?
So, it depends on individual circumstances of where and what they are in their life cycle. But basically, it isn't investing to put things into assets that make no sense in terms of price and the yield they're offering you. You'd be better off to take some money from your pot of savings and decide you're going to gamble with that and go buy yourself lottery tickets or go to a casino. If that's what you want to do, if you want to take a flyer, carve off some money and go do that. With the rest of your savings, the productive things are pay down your debt. First thing, get yourself into cash flow positive positions. Second thing is, it's your savings. It's not a game of craps. You need to keep it in things that are going to have a high security of principle. And, for us today, that means, we've been, adding some provincial debt, some municipalities, but generally speaking, the least risky credits are what is worthy of savings in this environment. Cash is not a bad thing to have, because what we're talking about here is opportunity that is likely to be generational. So when the world or the Americans realize that Mr. Trump is not the savior that they need or thought they were going to get, can't fix all things economic with one fell swoop of his golf club, and that's not even a criticism of Trump. That's a reality of the way that we have got into this predicament today is through the last 20 years of ignoring math, taking on unreasonable risks, paying too much for the wrong assets, selling in panic when everything comes down because no one had cash set aside. Now we're herding into passive ETFs, and I'm all for ETFs when they are, the right price. But when you're herding capital into ETFs because they're a long exposure to, certain assets, and you're thinking, well, I'm hardly paying any fee to own it. Yeah, that's great, but you also have no risk management there or any buffer whatsoever. So if things have gone up a lot and you just throw more capital into them, then you're also exposing that capital. Again, you didn't change the casino just by picking, this seat instead of that seat. You're still at the table in the casino, and at this stage, the odds are horribly stacked against retaining or extending the price cycle from here. So in other words, we're definitely in order is the correction phase when a bunch of this excess has to be taken off. So holding ETFs or being long mutual funds or, being with, any kind of sort of risk exposed security at this point is likely to be not very successful. You're likely to lose capital, and it may indeed take 5 to 10 years thereafter to recover the present value. So anyone that's near retirement, anyone that's got a bulk of their life savings already amassed, and is really thinking, gee, hopefully in another 5-10 years I may be able to pull back on work or, not work as much or whatever. Anyone in those brackets really has to be cognizant of the risk right now in terms of where we're at in this cycle. So it's not a question of, I'm sick of waiting, I'm going in kind of thing. This is not, are we there yet and stamp your feet. This is math measurements. It doesn't make sense to deploy capital, which is, your cash, your savings, liquidity, into insanely valued things. That's not investing, that's reckless behavior, and you're going to pay a price for that. So the good news is that, as I say, we're in a highly levered environment. We know that in many of the measurements we're at prior cycle tops or worse. No cycle goes on indefinitely, and this one is really set up to be quite a doozy in terms of what kind of opportunity we could see when all these sort of dominoes start to fall. So it's a time to be thoughtful and prepared, not to, put your mind on vacation and blindly have faith in things. That's never really worked in the past, but I think right now it's a particularly dangerous approach.
Are Canadians taking advantage of tax-free savings accounts?
Well, they had been. However, the latest reports suggest that they are not using them as much again, and I think this perfectly coincides with what we're talking about here. The increase in housing costs has attracted so much capital that people need. What are they withdrawing from RSPs for? Primarily housing loans, where you can take out a certain amount and use that towards housing. So people are just desperately sucking all the assets and income and everything they can find into this shelter category. And as I say, you need money for other things than just a roof over your head. And so I think TFSAs are a great tool. So are RSPs, any kind of place you can accumulate savings, all good. But you don't have to throw whatever, the principal you get in there, you don't have to throw it into crazy valuations. You can keep it in guaranteed deposits and cash and things while you're waiting for this better opportunity to come.
Danielle, as always, great advice.
Well, thank you. It's not crazy or fancy, but it does work over time, and I think that's where we have to keep our focus, not on all the shiny bits and crazy media marketing stuff that we're inundated with every day, but on, keep it simple and what works on an individual basis. And that's the kind of stuff that I talk about.
Danielle, thanks for being on the show.
Thank you.
My guest has been Danielle Park. Her website, jugglingdynamite.com. You're listening to HowStreet.com radio. If you have any questions for us or our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.